You're listening to the Reinvest Podcast, where each Tuesday we show business owners and entrepreneurs how to diversify into real estate by equipping you with the tools and tactics to build generational wealth. Your hosts, Garrett Gatton and Seth Ciminillo. Hey guys, welcome to the Reinvest Podcast, where we cover all things real estate investing, no fluff, no frills. We want to get into the nitty-gritty so that you feel confident that you've got tools on the tool belt to fundamentally execute and build wealth in the long run through real estate.
It's ironic that you say that, because sometimes that you bring on guests and it is hard to get like what's actually your thoughts or strategy on real estate. And it just does feel like a lot of like, well, you know, you just, I don't even know. They just kind of beat around the bush. But I think today's episode is going to be a little different. And we got a great guest lined up for us today.
Michael Ketchen from New Hampshire. Super excited to have you on the show today. Man, give us, what's it like in New Hampshire? It's 90 degrees here in Ohio and super humid. I don't even know what that translates for you, but.
It is 90 and miserable over here, brother.
Nice.
Between that heat and humidity, we're dying out here right now.
So you live in New Hampshire. Give us, like, we want to get into how'd you get started in real estate? I think it's a big question. A lot of the listeners on our show like to hear that Genesis story. Everybody's on-road seems a little bit different. Tell us, I guess, let's back up. Tell us first what you do today, just briefly, and then how'd you get into real estate?
Today, own a decently sized portfolio. Have about $250 million in real estate between multifamily and hospitality. Started about a decade ago, alongside my wife and our other founder of Commonwealth Collective, Matt. And I was a teacher, and we just wanted to do something different. And we thought we'd flip a house. Was Googling how to flip a house one night. Started looking for houses. Found one on Craigslist. And you fast forward, it's coming up on the 10-year anniversary here, and what a ride it's been.
Wow. So in 10 years, from teacher to $250,000, that's going to be the title for this.
$250 million.
$250 million in real estate. That's a lot of growth in 10 years, and started with flipping one house. Talk about, I think for a lot of people, ironically, I've heard a lot of teachers that have made transitions into like entrepreneurial real estate related stuff. Mm-hmm. For you, what did real estate hope to offer? Why that route and path of building wealth?
I think you hit the nail on the head. I think it's like everybody, right? I was just like everybody else. I wanted something else, but I didn't know what something else necessarily looked like. So I think one of the reasons you see a lot of people transition from education is my role in particular. I was the dean of students. I was an administrator at a very tough school, urban school, and we turned it around. So I think having a unique skill set in making chicken salad out of chicken shit, right? Really problem solving. And I think when you lean all the way into that, what I love about real estate investing, and the reason I truly tell everybody it's the greatest path to wealth creation in America, in my opinion, and I'll argue this till I'm blue in the face, is if you're a creative problem solver, you're only limited by your ability to execute. And if you can execute, you're going to have an abundance. Mm-hmm. So anybody can lean into it, whether it's flipping, wholesaling, self-storage, multifamily, Airbnb, you name it. And I really love that. And I think you see a lot of people transition because when you come from the world of education, you have to really problem solve. Every single day, you're dealing with a litany of issues. And that's kind of how we transitioned. And we thought, hey, we flip a house because we just wanted to make some more money. And fast forward, it's kind of a cool story, a full circle moment. That original house we bought it on Craigslist in 2017 for $300,000. We BRRRR'd it out in 4 months. And now fast forward, we actually just closed 2 days ago, another cash out refi on that building. Guys, it's wild. That building just appraised for $1.9 million a decade later.
Wow.
So we just popped another 564 out of it.
Wow.
That's awesome.
So you've refinanced on that house twice.
Oh, that was actually the fourth time in a decade. Yeah.
Wow, that's crazy. So for anybody who is new to the show or maybe new to real estate investing, you said you BRRRR'd the property. And it's a strategy that you guys, obviously, I think are pretty bullish on and like. Give us, for somebody who doesn't know, that might be a new acronym or they've heard it once, but they don't really have a full understanding. What is that strategy?
That's a great segue. So the BRRRR method, it really just is a refinance and pulling equity out. But what the acronym stands for is buy, rehab, rent, refinance, and repeat. And I think it's the greatest strategy, regardless of asset class, because the real power of real estate, in my opinion, is you get that tax-free, wealth event, that liquidation event, when you leverage that debt to then go buy more assets. And your tenant, your resident, the asset is now spitting off dividends to pay back the debt that you're reinvesting for a higher yield. And that method is what's allowed us to scale so quick. We've done a couple syndication and partnerships, but for the most part, we own all of our own stuff 100%. And it's largely through using that same tried and true method that I called the BRRRR method. That's what we do everything.
So this is, I don't, if you don't feel comfortable sharing this, then it's fine. But
I'll share whatever you like.
I'm going to ask the question anyway.
We're in this together.
We shoot straight. So, you mentioned leveraging, reinvesting that. So you guys have about $250 million, $250 million plus or minus on the day of real estate assets. How much original capital do you think you have in that?
What's funny, and there's a story there. I was sitting at a seminar maybe 3 years ago at this point, and some guy's on stage. I won't name him because he's a bit of a Yahoo, but he's big on social media. And he's talking about no money down, no investing, no capital. I look at my business partner. I go, man, what a sham. I hate when guys say this. And he looks at me and goes, hey, dum-dum, we don't have any dollars of our own money in our portfolio. And I went, oh my God, that's so real. So when we started, and I am full disclosure, I am not advising to do this, but we're big on the FAFO method. Again, as I told you guys, I'm trying not to curse as much on your show, but the name of my first book, a working book, is literally called Fuck Up Forward. And we got horror stories, but that first deal, we took out a SoFi personal loan, we pulled the HELOC, and my business partner's parents gave us $50K. And we did those three things to leverage up. We paid that all back, and it's been the same methodology every single time. Now we do it with millions of dollars, but what I believe, and I will, again, go to my grave, is I make it really simple. I'm not that smart. We can get into the method we use and how we identify a BRRRR and what that looks like. But basically, we would rather pay a higher yield to get more equity every single time. And the BRRRR method, if you're doing it correctly, means you have enough upside to execute to be able to refinance and pay back those investors every single time. And that's what we do. So we have, to answer your question, we have $0 of our own money in any asset that we own right now.
Yeah. So
that's so crazy.
Yeah, that is crazy. That's interesting. And that was a good question. So with this new interest rate environment, and I say new, I mean, it's been high for now the last 3 years, but before, obviously, with the advent of coming into, 2019, 2018 even, I mean, BRRRRs got really popular, bigger pockets. David Green released the book on BRRRR, right? And so it just became this
guy who doesn't know what a BRRRR is, ironically. Keep going.
It became this buzzword in real estate investing where everyone's like, I want to do a BRRRR. And to your point, a lot of people were just saying that, and they had no really concept of what that meant. Back in those days when interest rates were lower, and especially in 2020, 2021, I mean, people couldn't buy and BRRRR properties fast enough. Yeah. I mean, everybody was trying to utilize this strategy and have this velocity of capital, and interest rates were lower, and in some ways was easier because of that. Now things were flying off the shelf and prices were, rapidly increasing. But here we are today. Prices have not, at least in our area, have not had a reversal. Prices are still, slowly but surely going up. Now interest rates are higher than they've been in the last, decade. There's a lot of people who think, man, the BRRRR method just doesn't do it for me anymore. It doesn't work as well anymore. Right.
That was so 2020.
Yeah, or it's really hard to find a good BRRRR deal. And so I know you have some opinions on this. So let's dive into that. How are you guys still finding good BRRRR deals, even in high price point environments? Because, I mean, it sounds like you're buying in some areas where it's more than $100,000 house. So let's kind of dive into that.
That's a great, and I'll bring up some real life examples, but you said something that's important. And I think this is what gets lost in translation every single time, is it's really basic economics. So when everyone was jumping in, they gave up on the fundamentals. And what we have done, whether it's a low interest rate environment, or that's another thing I think we need to change the mindset on. We're not in a high interest rate environment. We were drug addicts that were addicted to cheap debt for 20 years. That was being propped up. Interest rates today are just what they've always been historically. Right? Yep. The fundamentals of doing a good real estate deal is I do not buy real estate that I hope will go up. I buy real estate that I can make go up. And that applies to a large, $20 million multifamily building all the way down to $100K single family fix and flip. So to make it simple for your listeners, The way we do it, like I said before, I'm really not that smart, guys. We take, if it's a commercial property, we focus on the NOI, the net operating income, which is what determines the value at the cap rate. And all we do is we look at the in-place NOI, and then we look at what we're projecting for the stabilized NOI, the stabilized net operating income. Then we look at the delta that's going to be needed to stabilize that property, whether that's rehab, management, expenses, whatever it might be. We stress test, and at 70 to 75% on a cash out refinance, we go as high as we can with interest rates to make sure we maintain a 1.4 DSCR. Once we understand that we're at that ratio, that's the max leverage we'll take. So basically, to make that simple, if I'm buying something for $1 million and I know it's going to need 200K in rehab, I need to be able to pull out 1.2 million in permanent debt, and that 1.2 million needs to be at least a 1.4 DSCR. Those are the basic fundamentals. What was happening in the economy where everyone was getting in trouble is they were buying a single family. They were throwing on an Airbnb or throwing a renter in, and they were taking a no-doc cash out DSCR loan. And they weren't looking at, okay, can this market support this many rentals? What is the market rent like? How many units are under construction? What are the economic drivers? What happens if interest rates go up and supply and demand drops? They ignored all of the fundamentals, and now they cry about it on social media. Some of those guys you mentioned, for example, and they don't take any responsibility. Well, these are the same guys that on YouTube 4 years ago were bragging about buying multi-million-dollar homes in Arizona because they said they have to go up. You can't be a victim. You ignored the fundamentals, you got in trouble, and that's the problem. Be a big boy, strap on your boots, and get the fuck back after it.
Yeah. So I think what I heard you say is there's a principled approach that you guys take to the deals that come across your table. Now, this is a thread that I want to pull on a little bit further. BRRRRing a single-family house with a DSCR loan is different than the financing mechanisms to do a large-scale commercial property. As you guys began to increase the complexity of the types of real estate transactions that you were doing, how did you see the financing mechanisms change with the larger deals?
Look, that's a great question. As we mentioned, right now, the reason I kind of chuckled at the BRRRR thing is in the last 12 months, I've successfully executed between single family, luxury STRs, and multifamily. I think I've had 8 or 9 BRRRR cash outs in the last 12 months alone. We just did 3 this week. I just did another one in Arizona on a luxury home. It's still happening. To answer your question, how you navigate it. So let's talk about a DSCR loan. Every DSCR lender only needs a 1-to-1 cover. Right. Yeah. And a lot of the ways these guys underwrite, it isn't real underwriting. They take the taxes and the insurance and they say, oh, here you go. It's a market analysis.
Right.
Understand the rules of engagement. That loan officer is financially incentivized to make that loan. They are not your friend. They get paid when a loan closes. Your responsibility as the investor is to stress test the market, stress test the rent. And that's where that 1.4 DSCR comes in. The more delta I have, the more runway I can protect. Yeah. Right. So if it's an STR, for example, we don't just rely on a Price Labs or an Air DNA. We look at other comps. We talk to other management companies, other operators in the area. We look at what's going to make our listing unique. For example, I have one right now in Bozeman, Montana that's done incredibly well over the years. To this day, I'm the only 6-bedroom, 5-bath, pet-friendly house with a hot tub in the entire market of Bozeman. Well, what did we do to BRRRR that one out in this environment? We bought it as a 2,500 square foot single family, 3-bed, 3.5 bath. We doubled the square footage by finishing the basement. We forced that appreciation, right? On the commercial side, we buy heavily distressed assets that are 60, 70, 80% vacant, or they need construction, or the rents are half of what market should be. That's how we force that appreciation. We don't just buy it and hope that the interest rate's going to play nice.
So what's the difference? You guys are obviously very dialed in on here's our criteria for taking on a new investment. Talk about that from a geographic perspective. Because once you start doing deals and you start getting deals come across your desk from markets that you haven't invested in, and it may be a great deal on paper because the property is distressed and the value might be there, but you've never invested in that market before. What's your core markets, and when would you guys jump into a new one because the deal's that good?
You just hit the nail on the head. So on the multifamily side, we have a due diligence process we go through. We have a 26-page due diligence document. And believe it or not, a lot of that isn't necessarily the building facing. It's the market facing specifics. And then what we rely heavily on, we pour into our broker relationships. We evaluate. We do random things. For example, when we're looking at a new market, we'll go at night unannounced. We want to do a light check. We want to do a neighborhood watch. Is there a cost and a hardship there? Potentially, yes, there is. But if we're going to go in and invest millions of dollars, we want to be serious. I don't expect everybody to do that. So what I would tell you, if you're sitting at your computer and you're looking at Google or ChatGPT, we run analysis. We say, okay, how many units are under construction? Who are the economic and what are the economic drivers in this market? What is the crime rate and how does it stack up by zip code, both locally and nationally? What are the school districts like, right? Mm-hmm. What are people paying for Section 8 housing or affordable housing? How many vouchers are in place? And then my team gets on the phone and calls and actually verifies that information. So all of those things are going, right? Like, for example, I have one in my inbox right now. It might be the first deal we do in Dallas. Well, we've been sitting on it for about 21 days while we evaluate that part of Dallas, Fort Worth, to see if we want to go into that market. I could have jumped at it on paper. It's a deal that previously traded at $90,000 a unit on 160 units. We're being offered to pick it up at $34,000 a unit.
Wow.
Right. So now it needs $4 million in rehab. Right. But our blended basis is still going to be so below what it was previously. And more importantly, back to those fundamentals. One of those rules, everyone's heard of the 1% rule, right? The purchase price per door equals 1% of the rent. Here, the baseline rent is $980 for a one bed. Our all-in basis will be half of that at about $54,000 a unit. So that delta, the wider that delta, the more comfortable we are, as long as it's not a war zone. And I don't want to make it sound like this is perfect. Guys, we learned lessons like everybody else. We stubbed our toe multiple times, right? I started the call by saying, I have one building in Cleveland. It's the only deal to this day I regret buying. Because we did all of our typical due diligence. We relied on a broker. We went to the neighborhood. It all looked great during the day. I kid you not, I think 6 weeks after we closed, every building around it got condemned and shut down.
No.
What?
So a variable that we had no way to control, right? So now we've had to deal with gangs. We've had to deal with everything else. We BRRRR'd out the property. We got all of our money back out like we always do, but it's become a nightmare to manage. The risk reward is out of whack, right? So what process do we take control of? Now we look in with the building. We look at tax liens. We look at the surrounding neighborhood. What's going on with my similar owners? Back to that 26-page document. That's how thorough we try to go when we bring in a new acquisition.
How did you guys build that system?
Well, real quick before you jump into that, because that's, I do want to know that. But for that deal in Cleveland, I mean, do you feel like the broker was a little misleading on that for you guys? I mean,
1 trillion%.
Okay.
And we have a relationship, and he had brought us, this wasn't some guy who called me cold. This is someone we had done 3 successful deals with of scale. Okay. And what I found out after the fact, and we had a very colorful conversation. The owner on it was the head of his brokerage.
No.
So he was incentivized to move it, and he got the out-of-state guy that's been easy to work with. So needless to say, our relationship isn't great anymore. But again, I'm a big boy. I take responsibility.
Yeah.
That's on me.
Yeah, that sucks though. Because I was just going to ask about how you're building, like to your point, building broker relationships is really important. And that was a sticky situation though for that one. That one's terrible.
It was, but it also reinforced, our core values that now we have. That was a few years ago. We didn't have them yet. Now as we've grown so much. And one of our core values that me and my team, it's drilled into us, is trust but verify. Yeah. I trusted, I didn't verify. Yeah. Right? Now you have this due diligence Bible, if you will, that's 26 pages. And again, it's real estate, guys. Every day there's going to be a crisis. I tell people all the time, this is the greatest, hardest asset class in the world, right? Because you can do anything you want. You can build whatever life you want, but the bigger problem you solve, the bigger headache you get, but also the bigger reward you get. And that's how real estate plays.
That's good. So this 26-page due diligence document, you guys didn't get, 10 years is it sounds like a long time. You've covered a lot of ground in a short amount of time. Did you do this all through reps? Did you do this through getting reps and having some coaching along the way? How did you kind of back into this is our process?
That's a great question. And a kind of a story to go with that. A combination of everything. What we found were talking to other people in the space, kind of taking what they were doing. And then we ended up on what we call the Commonwealth Way. And that's another lesson. About 2 years ago, we thought we were really going to explode going into new markets. So what we did was we tried to, quote, institutionalize ourselves a little bit. We thought the best way to do something, because we do a lot of unconventional stuff. For example, one thing we do, we remote manage all of our properties across the country. That includes, a couple 100-unit building size assets, right? We have a whole process. We thought we were going to move away from that because we just thought that's what you do when you scale. That was horrible. And it actually took my controller at the time to make a comment. He said, you guys have never failed on a deal. Why would you change what works? And it was amazing when you hear that from somebody else. So we went back to what we call the Commonwealth Way. And the Commonwealth Way is just the processes that we use on the management side, on the asset management side, on the acquisition side. And we really lean into that with our team and our culture. And that's what's really helped us explode over the last 24 months is really building into that culture and the team and everything that we do. And, really pouring into your people. Some stuff we do that's kind of unconventional. We give unlimited PTO, right? We give a lot of bonuses. Everyone on our staff is financially incentivized for performance. And that's one of the issues in real estate. A lot of property management is incentivized by top line revenue, and then the owner is incentivized by bottom line NOI. We flip that on its head. Our entire team knows what NOI means. They know what all these buzzwords mean. They know what they're aiming at.
Interesting. That's really interesting that you kind of restructured how the business works so that everybody was in alignment with what the outcome needed to be.
Did you guys,
I just want to go one step further there, because back to the unconventional stuff, and I think it's important. We realized we actually had two businesses within property management because we go really fast on the value add. So what we do, for example, we have terms that I don't know any other company that does. We split the entire property management company into what we call unstabilized, which are buildings that are getting ready to refinance. And then at the refinance event, they hand the baton off, for lack of a better term, to the optimization team. So the optimization team takes it post refi and they're focused on increasing NOI. That stabilization team, they're our Navy SEALs, they're our war hogs. They go fast, they break stuff. It's get to the finish line as fast as humanly possible. And they're like our Navy SEAls, and we call them deployments. They might work nonstop for 6 months and they might get 6 weeks off straight while we're in between deployments, right? So it's like trying to play it out of the box. But it's like, hey, if I put a big pot of money at the end and I give you all the tools and I say, go, just go. Get to that finish line as fast as you can. Yeah. Because the way we raise capital and the way we structure our deals, we have to go fast.
So in those scenarios, do you send people out on site for that period of time during a reposition?
We always have someone on site that we call bogs, boots on the ground, right? And then we do a ton with AI. But we also do a ton with, I have a leasing agent who's one of the best in the business. She's on the unstabilized time. She works the phone nonstop in multiple markets. She will fly out if she needs to. We have a 158 unit building in Texas that we're coming up on the finish line now. We bought it 8 months ago as a foreclosure. It was 80% vacant. And out of those 80% of vacant units, probably 90% of those 80% were down. They were unrentable. We went through the whole thing in 5 months, all new exterior plumbing, all new interior plumbing, all new roofs, exterior painting, cosmetic turns, you name it. She's now leasing that up at 20 to 25 units a month. Wow. So you're going to break stuff when you go that fast, guys.
Yeah.
Wow.
Yeah.
Dude.
You're burning rubber.
I would love to be a fly in the wall for one of your guys' turnarounds on these things. That's crazy.
I'll throw it out there to you and I'll mention it. We're actually doing a conference in October. Back here in New Hampshire, the Bet on Yourself conference. We'd love to have you guys out, and we can work in a property tour for anybody who wants to see. And I'm getting off this call and signing some more LOIs. So we're always buying deals like this, and I'd love to have you guys out, or anybody from your community out.
So you mentioned your the way you finance these deals. What is that way?
I would say if I could give anybody any piece of advice, and I don't know if anyone else thinks of it this way, but this goes back to the education question you asked earlier. I joined a really high level mastermind that changed my life. It was incredibly expensive. It was like 50 grand to enter. I was sweating it. I'm like, wow, that's a lot of money. Changed my life because I went into that room thinking everybody else did everything better. By the end of it, I realized I actually love the way we do things, but I needed that confidence and that clarity. So I believe in real estate, and I'm open to debate it, but I hate fees. I really don't like syndications traditionally. I like equity. Equity is everything. That's what I try to tell people. Cash flow is great. I work for the cash out refi. I work for the ownership. So the way we structure all of our deals, now we have a fund. I don't know if you guys got any LPs out there, but we'd love to talk to them. The way we structure every one of our deals, and this is important to understand when you're doing a BRRRR deal. I want your whole audience to understand the whole method to the madness, okay? We buy one of these distressed deals. We get what's called an interest reserve or an interest carry. So we don't have debt service for that first 12 to 18 months, okay? The way we raise the equity and or the down payment is we raise that in a fund we have that acts like debt. So they come in as our equity. We pay as high as 15% to our investors on that side.
Hmm.
However, when we refinance and we pay them back, they're paid back. They're out of the deal. We own 100% of the deal.
Yeah.
So we get a lot of guys that are sitting on 2, 3, 4, 500K. Some guys are $1 million. They just want to clip a coupon, because the other thing that, I don't know if it's the smartest thing or not, we've just always done it this way, that I found out other guys don't. It kind of killed me. When you invest with us, we pay you monthly. So you're getting a dividend every single month.
Which is a lot
Well,
more
we can only do
management
that.
to issue those.
Say it again?
It's a lot more intensive on your bookkeeping and on your logistics to issue that. But it's time
100%.
value of money. Those guys are starting to get a return back. You know, that's the thing about syndication, is something that can look really good on your IRR, but when is that capital coming back to you, right? And if it's all on, you know, at the end of a deal or something, you don't have the use of that. So essentially you guys you have a debt fund. Explain to me, it went over my head a little bit. What is that? How are you 12 months without a debt service on, what'd you call it, an interest reserve?
You can get an interest reserve and interest carry. So like, let's walk high level through the deal in Texas. Okay. I'll give real numbers. So we bought it for $5.7 million. It was a foreclosure from Wells Fargo. We had been negotiating with them for 6 months. They kept going with other groups, and those groups couldn't close. We finally came in, got it at the price we wanted. We had a $4 million rehab behind that. Okay. So the total capital stack was 9.7 million plus closing costs and all that. What an interest reserve or an interest carry does is a lender will take 1 year of that interest amount, meaning the monthly payment. They'll roll it into the loan, and then at the closing, a percentage of that is part of your closing cost. So they add together 1 year of mortgage, all of the rehab, all of the acquisition, and then we had to bring 10% of that to the closing.
I see.
Okay.
So that 10%, for simple math, let's just call it, $10 million just for simple math. We would have to bring $1 million to closing. Well, we go and raise that $1 million from our own debt fund. We're paying our debt fund investors between 10 to 15% for being with us. Well, now that building that's still 25% occupied at closing, it's spitting off 40, 50 grand a month. That 40, 50 grand a month can cover that debt service on that debt fund payment every single time.
Interesting. So they're
and then
willing
you have
to,
essentially a year runway to execute your business plan before your debt service payments start actually kicking back in.
You nailed it. And that's where the timelines, the forced appreciation, the value creation, the DSCR model, that's where it all ties together.
So it's a great way to bring a lot less cash than you normally would to a deal, but you just got to execute your plan and get your butt in gear.
Yeah. So when I say the BRRRR has always been alive and well. The problem in the last couple of years, when it was the cheap lending environment, people thought they were BRRRRing a property. No, a real BRRRR means you force appreciation. What they were doing was buying a cheap coupon, and they didn't understand what they were buying.
Yeah.
That's good. That's good.
Okay, this is great. We're going to jump into our smaller pockets segment. So, Michael, go ahead and tell us about a deal that went wrong. Okay, it could have been something early on, could have been something recent, but a deal that went wrong, and then more importantly, what did you learn from it?
Oh, God. I'll actually go way back in the time machine, because I think it's important for anybody trying to start. It was the fourth or fifth deal we did, and to this day, knock on wood, it's the only deal we've ever lost money on. I learned so much on it. We were starting out like a lot of people, right? And everything's shiny object, okay?
Yep.
So we had BRRRR'd out 3 Airbnbs at that point. We had our first multifamily. That was a 13 unit that we still own, ironically. And everything was working. I hear, funny enough, a Bigger Pockets episode where there's guys talking about ADA levels, right? And I'm like, that sounds great. How hard can it be to add a level to a house?
Okay.
So turns out it's pretty freaking hard. So we bought this house in New Hampshire, and I hired a GC who I knew was my cousin. He screwed me. We had no idea what we were doing. The whole thing goes to hell in a handbag. We get to the finish line. We made just enough money to either A, take some profit ourselves, or pay back my one friend who had been an investor on the down payment. It wasn't a lot of money. It was like 75 grand, but it was a lot to him. It was a lot to us at the time. And this could have crippled us, because like we had just gone full time. I had just left my teaching job, but we made the decision, we're going to pay, because that's the right thing to do. We're going to pay him back.
Yeah.
We ate, well, looking back, I mean, I don't even know if it was like an 80K loss. It was some kind of loss we couldn't afford at the time, but it was the right thing to do. What I learned is I had to step in, and I had to finish the project. I had to start to communicate with subs, communicate with the town, talk to the lenders. I had to figure out how to trust but verify. All the foundation of Commonwealth Collective was being born. I found out that loss could carry forward as a passive loss, which ended up being helpful because we flipped a couple of properties the next year to keep food on the table, right? You guys got to understand context. When we first started and I left my teaching job, I went from making $100K a year down to making $3,000 a month. So losing, whatever we lost in that house was not fun. But I learned so many lessons, and I realized I could never give up that level of oversight again. I could give up control to scale, but I had to have the solid foundation to do it. So the reason I share that story with everybody, we changed it. We don't say lose. We don't win or lose. You win or you learn. And we learned a lot on that. And obviously it took off. And I would tell everybody, regardless of where you're at, whatever project, whatever climate, whatever season of life, there's always sunshine at the end if you keep walking ahead. Yeah, and that was kind of our takeaway.
Here's what I'll say about that. This is why we like doing the podcast and having those kinds of stories, because, dude, when you get the wind knocked out of you, and here's the thing about real estate, it's an illiquid asset. There's no quick about anything. Yeah. If you get yourself in a hole, it's going to take some time to climb out of it.
You're sitting in a messy situation for months. I mean, you knew you were screwed in that deal probably for months before it closed. And then it was like just a blow even after it closed because there was no light at the end of the tunnel. Yeah. There was no gold at the end of the rainbow on that one. But the important lessons, the grit that you can learn from stuff like that, and for you to keep moving forward despite having a major loss early on like that. I mean, you're looking at that and you're like, that was a whole year's salary.
I remember thinking, and on top of that, we were in the middle of trying to refi a couple buildings that was becoming a nightmare because the credit union, this is rolled into it. We were in the middle of taking off, and so many things to look back on. I thought real estate was easy because this bank just kept giving us loans. Come to find out, they were having all kinds of issues. This lady shouldn't have been doing what she was doing. We were a year and a half in the business. We were going to become their biggest customer when the president of the bank finally stepped in.
No.
He's like, we don't even have a tax return on these guys yet. I'm like, what? You need a tax return? We were so green. We had no idea. But again, I go fast, right? So now they trap my portfolio.
Props to that lady who helped you guys get your start.
Yeah. Shout out Christine Lewis. I'm trying to do a refi. I'll never forget. I'm in a steak dinner at my buddy's birthday, and I'm talking to Visio lending on one line. I'm talking to Lima One on the other line. I'm trying to untangle my portfolio. Why, knowing I'm signing documents on a house I'm about to lose like $100,000 on. And I'm like, and I just started laughing hysterically in the middle of the steakhouse. I'm like, this is what you asked for, asshole. Now you better go figure it out and bet on yourself. And that's what Bet on Yourself was born, So there we go.
No, I love it. And
Dude,
doing the smaller pockets is just, if you guys get a loss out there, it's okay.
It's all right.
It's the consistency. It's going to keep moving forward. And obviously, if you don't learn from your mistake, then that's on you.
Who was that guy Aspen Funds?
Oh, Ben Frazier?
His dad.
Bob Frazier.
Bob Frazier. We had a guest on. His name is Bob Frazier. And, man, he went through, made tons of money on Wall Street, lost it all.
Yeah.
Made it back again.
Lost it all again. Through the 2008 recession.
Just crazy
So
story.
he lost in the dot-com bubble, lost in the recession, and now here he is, today they're doing really well.
Yeah.
And, his whole point was that stuff was foundational.
Yeah.
And like what you said, your 10 years of pain, now you have a 26-page due diligence process where you guys are locked in on your systems. And, that's what it does for him. And everybody has to put in that hard the lessons of hard knocks, right? And you have to learn and pay that tuition so that way you have a really strong foundation and a really strong process.
And here's one of the other things that should encourage you: the more hardship you've been through, it makes your business more hard to replicate. Because the stuff that you guys have been through, your processes today that are causing you to out-compete the guys and the companies that you're bidding against, are the things that came out of the hardships and the trials along the way. And it just becomes really hard to replicate because other people haven't gone through that yet.
Yeah, if we decided to uproot and go to New Hampshire and start a competing firm, you would probably not be worried.
Well, I think you said something there too that every LP, every GP, every investor listening to this needs to hear. I think when you first get started, you think it's all the fundamental knowledge, right? You're like, give me the spreadsheet, give me the deal. The more successful you become, you actually realize it's literally 99% mindset and 1% of the technical aspects. And that just comes with time, and you got to put the work in to understand the value of mindset. Because when you first start, you don't realize how important mindset is.
Yeah.
Even when people tell you it's important, you're like, okay, it goes over your head. You don't understand.
If you haven't been through hard times, though, it's hard to have that frame of reference.
100%, 100%. You don't know. I mean, you're not even a real investor until you get sued. So.
That's a good. That needs to go on a t-shirt. All right, that's a great segue into what we call our little nugget. All right, Michael, this is a part of our show. You've given us a lot of great stuff already, but we're going to pivot a little bit. Give us, and I feel like you've got something. You just seem like the kind of guy that seems pretty dialed in on your why, okay? What is a tried and true unwritten rule, kind of the, universal laws of the universe that you operate by that you would say, this is why I'm successful?
Man, there's a lot. I would say, I think the most important thing now, and there's a lot you can do, is understand and revisit constantly building the business around your life and not your life around the business. Because this is a lonely road on entrepreneurship, and the more successful you become, the higher altitude you fly at, and fewer birds fly up there. So you need to understand what you're building, because the goal is never just money and grind. The goal is, what am I actually doing this for? And my whole philosophy is do what I want, when I want, with who I want. And if I look at everything through that lens in business, that might, I could do a ton of deals right now, to you guys' point. I'm passing on certain things because I don't need something else on my plate, right? I want to focus on our nonprofit work. I want to take care of my people. I want to take care of my team. What are you actually doing this for? Why did you start this journey? Did you do it just to have another job and maybe make some money? Or was it to take the weekend golf trip with your buddies? Was it to, one of my favorite memories this year was I flew a bunch of buddies out to Arizona to my place, and we had the most over-the-top, insane golf tournament for 3 days. We bankrolled everything. I didn't even want them to even think about it. And we made memories that will last well beyond anything we're doing in business. That reminds me of why I do what I do. And I don't think people visit that enough. Kind of the way I teach it and preach it is, once a quarter, sit down and ask yourself what you want your typical Tuesday to look like 5 years in the future, and work backwards. And I just think people get away from that too much. You need to lean all the way into that, because if not, what's the point of it?
So, okay, I think that sounds great, but talk to me as the guy, you're in a different spot. I'm starting.
Do you want a real estate tip you're getting started on?
No. I think it's a great piece of advice. My dilemma.
You're 10 years into it and you have
$250 million in real estate assets. I'm the guy just starting out trying to grind to make it happen. So how do 100%. I take that piece of advice and use it today with where I'm at?
It's so funny you say that, because when I coach, I teach guys. I had a conversation with one of my investors yesterday who's transitioning full time. I gave him the same advice. But what we do is we get granular. And what we say is, okay, we're going to build your buy box. We're going to build what asset class you're going into, and we're going to design your life. So what we say is, everybody tries to look at, I'll give you to make it more practical. Everyone looks at what they want. I try to turn it sideways and say, let's look at what you have to leverage to get what you want. Right. Mm-hmm. So in his case, he had a couple of retirement accounts. He had a couple of smaller multifamilies. How are we going to leverage those to start playing the game? Right. What asset class are we going to go into? If you don't have that clarity to know what you're aiming at, you're guaranteed to miss. So that's kind of the overarching point. And here's the thing. Your goals are going to move with you as you grow. But if your first goal, like my first goal when I started real estate, I just didn't want to set an alarm clock. If someone is making you set an alarm clock and making you check in on a calendar, you're not free. And I would take a significant pay cut. I did take a significant pay cut to achieve that level of freedom. So let's get real granular. Let's figure out what it actually takes for you to walk away from the W-2. Well, if you don't know what you're aiming at and you don't know what you're transitioning into, you're just going to start spinning your wheels, and you're likely to lose money and get in trouble and end up, hey, this doesn't work and I'm out of it. That North Star is your anchor point. That tells you I am walking this path come hella high water to hit that goal.
Mm-hmm. Yeah, no, that's good. And to your point, that goal changes and scales the more you grow, and that 100%. Whatever that life you want it to look like. And I think at some point when you start, you don't even know what you want. And so getting that clarity is important. And then it switches. A lot of people is like, man, I just want, to your point, to get out of the rat race or W-2 and just have some time freedom. Can I make any, you know, can I have some flexibility in my schedule? So yeah.
That's good advice, man. All right, Michael, as we kind of land the plane here, what's been one of the best resources in your business development?
Oh my God. There's so many. The advice I try to give everybody is as quick as you can, get involved in community and education and meetups and masterminds, because you need the positive energy of like-minded individuals rowing towards something. And everything around you is people projecting their fears onto you. And I am the biggest believer in the world of you are the average of the 5 people you most associate with.
Mm-hmm.
So I tell everybody, look at the 5 people you spend the most time with. If none of them are living a life the way you want, you have to quickly put up those barriers and get away from that. So it doesn't cost a lot to go to a meetup. It doesn't cost a lot to join a small mastermind or join a small community. And you watch what that does for your life when you show up ready to learn and receive and to give.
Mm-hmm.
Too many guys walk in there and they want a shortcut. It's like, no, show up and always try to provide more than you take.
Mm-hmm.
And I will challenge anybody to that. You do that for 12 months and watch what happens to your life.
I want to just put my stamp of approval on that. Not that it needs to be said, but I remember hearing that advice and I was like, okay, that sounds like the right thing to say, but but really, how do I get there faster? And dude, like literally the last 2 years, Seth and I both have put effort into really networking and being a part of different communities and adding value to people's network, and which translates to net worth. And now I'm like, okay, people trust me now. People are like, hey, Garrett's legit. He wants to help my business grow. And it's the whole Zig Ziglar thing, right? If you help people get to where they want to go, they're going to help you get to where you want to go as well.
I have a saying, and I'll ask you guys a question. You know how you become a billionaire? You make a lot of millionaires.
Yeah. Wow.
Say that again. Just say that again.
So you want to know how you become a billionaire? You make a lot of millionaires. And we just came from an experience. I have a mentor who's super private. I won't say his name on here. And he's a really good buddy. Most successful guy I know personally. Company does like $1 million in revenue every 2 days out in Hawaii. And basically, to get time with him, I value it so much. You got to curate unique experiences. So you want to talk about pouring into education to show my money where my mouth is? I put together the most unique 4-day mastermind in Dominican Republic I just came from, where, I mean, each guy dropped like 35 grand a guy. So yes, it scales with you. I am telling you, in the last year alone, I have probably spent almost 200 grand on my own education. I'm basically buying a master's degree every year. And sure enough, my life is exploding.
Yeah.
Now, when I first started, it was free masterminds. That's my point. It's not about the price point. That just keeps getting you in the next room. It's all about how you show up and provide that value. So at every level, and I share that story to tell you, like, if you want to get those kind of people around you, curate the environment where those people want to be around you.
Yeah.
And that's kind of what you'll see show up.
Man.
Yeah, that's good.
This is a good episode, man. All right.
Tell Xander was better than his. That's all I want.
Michael, where can people find more about you and follow your success?
I really post everything on Instagram. Shout out to my team, Kaylee and Danielle. They do an amazing job with the education media company. They make all of this happen and look halfway decent, which is hard to do as a chubby, bald redhead. But on that note, again, I said it earlier, we're doing something I'm so proud of. I raised a ton of money for veterans. We're in the process of making that an official nonprofit. Shout out to Project 2222. So please hit me up on Instagram. And we have a conference coming up in October in New Hampshire, the Bet on Yourself conference. First time we've ever done it. And here's what's unique, guys. And we want to get with you guys and give a promo code to your listeners. We have actual operators coming. My buddy Michael Elefante is coming if you're interested in Airbnbs. My buddy Michael Miller, if you're interested in creative finance and sober living. My buddy Xander, who's like a brother to me, is coming to talk about RV parks and glamping. Ian Bishop, who's the RevOps, one of my consultants. Grant Frankie, who's one of the best guys. He's been all over Bigger Pockets. All my buddies are coming. And the one theme, you cannot speak at this conference if you're not actively running a business. We want to make this real and tangible. We don't need more fucking gurus. We want real guys doing real things.
Right. Yeah. That's good.
Yeah.
Yeah. That's what people need right now. No fluff. Really, you call it boots on the ground earlier. You need that from an operational perspective. So,
100%.
Michael, it's been awesome, man.
Yeah.
Thank you so much for taking your time and imparting this stuff to our listeners.
Thank you guys for having me. It was an honor. I can't wait to do it again.
As always, excited that you joined us for another episode of the Reinvest Podcast. If you want to learn how you can use your hard-earned capital to diversify into real estate, go to our website, reinvestcapital.us, and shoot us a message. Move farther, reach higher, and grow deeper.